Everyone is watching the tariff, the 50% number, the White House announcement, the threat, the punishment. But if you want what actually happened in the aluminum trade between the United States and Canada, you need to look past the headline, past the press release, past the political theater. Look at where the metal actually went. American manufacturers now pay nearly $6, $200 per ton for aluminum. Europe pays just for dollars, $300 for that same metal. That gap sits near to dollars, $0 a ton. And that gap was created almost entirely by one decision in Washington. Trump imposed a 50% tariff on Canadian aluminum, expecting full compliance, expecting Canadian producers to accept worse terms, expecting the supply chain to bend to American will. Canadian producers looked at the numbers and made an obvious, rational decision. They stopped prioritizing American buyers and started shipping metal toward Europe. That was not a protest. That was not retaliation. That was math. And that math is now rewriting the global aluminum trade in ways Washington's tariff architects never anticipated. For decades, the United States was the default buyer of Canadian aluminum. Smelters in Quebec built entire supply chains around trucks rolling toward Detroit. The relationship worked because proximity made American buyers the cheapest option, the cheapest buyer, the closest buyer, the most convenient buyer. Trump changed that equation in March, reinstating a 25% tariff. In June, Washington doubled that tariff, pushing the rate to 50%. The goal was simple: pressure Canadian producers into accepting worse terms, force them to absorb the cost, make them come back to the negotiating table. Instead, Canadian aluminum makers discovered something more profitable across the Atlantic. Quebec's export data tells the story with brutal, undeniable clarity. In the first quarter of this year, 95% of Quebec's aluminum went south to the United States. By the second quarter, that share had collapsed to 78%. Meanwhile, Europe's share of Quebec exports rocketed from near zero to 18%. That is not a gradual drift. That is a rerouting of supply. Quebec represents roughly 90% of Canada's aluminum smelting capacity overall. Aluminieri Aluit, North America's largest smelter, confirmed this shift in stark terms. Its European shipments jumped from 4% up to 57%. One company, one quarter. A complete reversal of its export direction. Rio Tinto, one of the largest players here, reacted just as aggressively. Reports indicate Rio Tinto curbed direct shipments into the United States entirely. Instead, the company began buying metal from rivals and reselling it domestically, a maneuver that let Rio Tinto serve American clients without absorbing the tariff. Halcourt, another major producer with deep Quebec roots, faced the same decision and made the same calculation: sell into a market paying $6, $200 per shift. The math simply did not favor staying loyal to the American relationship. Aluminum is not some niche commodity. It touches cars, beer cans, buildings, every soda can, every card or panel, every aircraft fuselage. It depends on this exact metal. So when tariffs distort its price, ripple effects touch nearly every industry. The Midwest premium, the extra cost on aluminum, tells its own story. That premium jumped 82% since early June. A staggering move. It hit an all-minus time high near to $550. American buyers are now paying a historic penalty for supply. The London benchmark price sits far lower, near $3. Zereth, that benchmark represents the global baseline price before regional premiums get added. The gap between baseline and American price shows the tariff toll. Economists have a simple name for this: deadweight loss. Someone always pays for a tariff, and that someone is the buyer. Canadian producers, by contrast, found a buyer desperate enough to absorb supply. Europe's aluminum market had been under serious pressure before the shift began. Instability tied to the Iran war disrupted supply routes across the region. That region accounts for roughly 9% of total global smelting capacity. Buyers everywhere scrambled to secure alternative, reliable sources once supply got disrupted. European duty minus paid premiums surged 73% since that conflict began. They hit a record $621 per ton. Canadian producers, locked out of profitable American sales, arrived at the moment Europe needed them most. Bank of America estimates Europe faces a 5.6 million ton deficit. That number dwarfs the entire global shortfall, which analysts peg near 1 million tons. It also exceeds the shortfall inside America, near 3.8 million tons. In other words, Europe needs metal far more urgently than America does. Canadian producers found themselves holding the exact product a desperate buyer needed. This is not charity. This is simple, cold, profit-minus-driven business logic. Jane Simard, president of the Aluminum Association of Canada, explained the calculation plainly. Once that math gets done, the European option becomes clearly more attractive. That single insight explains why Canadian metal keeps flowing east, not south. Statistics from Canada's alt-raid data confirm this shift with striking, unmistakable numbers. Canadian aluminum exports jumped 507% in one reported month. That pushed the total value up to $12 billion. It was the highest monthly figure recorded since that year's peak. The Netherlands became one of the biggest beneficiaries of this export redirection. Dutch minus-bound shipments rose more than 70% compared to last month. Italy nearly doubled its purchases of Canadian aluminum during that same period. Greece also emerged as a significant new destination for Canadian aluminum shipments. These are not random countries. They represent genuine European manufacturing demand centers. Rotterdam, Nederland, Athens. They now process aluminum that once flowed toward Detroit. Canada's broader merchandise trade numbers reflect just how significant this shift became. The country posted a trade surplus of $4.2 billion. That figure represented the strongest monthly surplus Canada had seen in years. Total merchandise exports reached a record $77.1 billion. That extended Canada's export growth streak to 4 consecutive months of improvement. Aluminum alone was the single largest contributor to that export growth story. Now, this was the outcome Washington's tariff architects originally intended. The tariff was designed to pressure Canada into renegotiating trade terms favorably. Instead, it pushed Canadian producers toward new customers who pay premium prices. Canada's government had already launched a $3.6 billion fund designed specifically to help producers absorb tariff-minus-related damage. In hindsight, that fund may have simply bridged producers toward a market they were about to discover anyway. A tariff meant to weaken Canadian producers instead helped them find buyers. American manufacturers, meanwhile, are stuck, paying historically elevated prices for a shortage. A shortage that exists because the traditional supplier found a more profitable buyer. Every downstream industry using aluminum now faces higher input costs than before. Car makers, beverage firms, construction companies. They absorb some of that cost. Eventually, those higher costs tend to reach ordinary consumers through retail prices. That is the quiet, invisible mechanism through which tariffs actually function. Not the headline, not the political victory. The price increase you notice at the store, months after the announcement was made. But this tariff war is far from over. Washington is watching closely. Analysts now warn this shift could become permanent, not a temporary reaction, a permanent rerouting of a commodity supply chain. One structural factor makes Canadian aluminum especially attractive to European buyers now. Canadian smelters run mostly on hydroelectric power, producing very low carbon aluminum. Europe's carbon border adjustment mechanism increasingly rewards buyers who choose low carbon metal. That regulatory incentive gives Canadian producers an edge over higher carbon competitors. Middle Eastern and Gulf producers typically rely on natural gas powered smelting. Their aluminum carries a heavier footprint compared to Canada's hydro powered output. So European buyers get to benefits at once. Reliable supply and cleaner metal. That combination makes this shift more durable than a simple price story. Global aluminum demand keeps climbing, regardless of where the metal gets produced. Industry forecasts expect global casting usage to reach 24 million tons. Casting remains one of the most demand-intensive applications for primary aluminum. The extrusion segment, covering construction and transport, also depends heavily on this. Automakers increasingly favor aluminum for lighter vehicles, especially inside electric vehicle platforms. That structural demand exists independently of any single tariff or trade dispute. So even without the tariff shock, Canadian aluminum would likely find buyers. The tariff simply accelerated a redirection that broader market forces already supported. Still, not everyone believes this European shift will remain permanent going forward. Freight costs across the Atlantic run considerably higher than shipping across borders. Currency swings between the Canadian dollar, the euro could shift economics. European demand cycles could soften, especially if broader continental growth slows down. There remains a real chance Washington eventually renegotiates or adjusts this tariff. Gregory Whitbeck, a commodity advisor, believes American premiums may need to climb further. He estimates the Midwest premium may need to reach to $600. Only at that level would Canadian producers find America competitive with Europe. Until then, economic logic clearly favors continuing shipments toward Rotterdam and Milan. Some analysts raise a separate concern about where Europe's supply actually originates. There's worry that Chinese aluminum could get rerouted through European channels. If cheaper Chinese metal enters disguised as European supply, pricing could shift. That concern adds genuine uncertainty to an already complicated global trading picture. For now, though, headline numbers remain squarely in Canada's favor. This year, Canada exported roughly 2.6 million tons of unwrought aluminum yearly. Even a modest percentage shift toward Europe represents a massive dollar amount. Every percentage point move toward Europe strengthens Canada's position with Washington. Eventually, that leverage matters enormously as broader negotiations between the two countries continue. Trump's original tariff strategy assumed Canada had few alternatives beyond America itself. That assumption turned out fundamentally wrong. And the numbers prove it. Canada found buyers, secured record prices, and strengthened its trade position instead. Meanwhile, American manufacturers are left absorbing costs to keep climbing monthly. Construction firms and beverage companies all quietly pass costs downstream. Eventually, consumers rarely notice tariffs directly. They simply notice prices creeping upwards slowly. That is precisely how this aluminum story connects to everyday household budgets. A can of soda costs slightly more because of decisions made recently. A new car costs slightly more for the exact same underlying reason. These effects are subtle individually, but they compound significantly across an economy. Economists call this phenomenon tariff pass-minus through, and it rarely favors consumers. Producers, exporters, and foreign governments frequently find workarounds. Domestic buyers simply cannot. That asymmetry explains why tariffs often fail to achieve their stated goals. Canada's aluminum pivot stands as one of the clearest real-time examples of how quickly global capital and commodities can reroute around barriers. Modern supply chains are simply too flexible for blunt, single-country policies. Producers chased profit wherever regulation, geography, and pricing happened to align favorably. Washington aimed to pressure Ottawa, and instead pressured its own manufacturing base. Other countries are almost certainly studying this exact playbook for themselves now. If tariffs consistently produce this kind of backfire, alternative strategies gain traction. Trade diversification, once viewed as defensive, now looks genuinely opportunistic instead. Canada didn't just survive this tariff. It may have actually profited. That distinction matters enormously for how future trade disputes structure. Policymakers in Washington will need to reassess assumptions behind future tariff decisions. Simply raising a tariff rate does not guarantee the intended economic outcome. Global markets, especially commodity markets, respond to price signals faster than expected. Aluminum, oil, copper, and other commodities all move toward wherever demand pays best. This aluminum story is ultimately a lesson in basic, unavoidable market economics. You cannot legislate away price arbitrage when alternative buyers exist and pay more. European buyers needed metal. Canadian producers had metal. And the deal fit. No amount of tariff pressure changes that fundamental reality on the ground. Going forward, expect this story to remain a recurrent theme in commodities. Copper, steel, and other tariff-affected metals may eventually follow a similar pattern. Whenever Washington raises tariffs, watch where that country's exports quietly relocate next. That redirection often reveals more about tariff effectiveness than official statements do. For Canadian producers, this moment represents a genuine strategic one worth celebrating. For American manufacturers, it represents a costly lesson in unintended tariff consequences. For European buyers, it represents welcome relief during a genuine supply shortage. And for Washington, it represents a policy that did not work as intended. The numbers rarely lie. And these particular numbers tell an unmistakable story. A 50% tariff was supposed to weaken Canada's aluminum industry sharply. Instead, Canada posted record export values in its strongest trade surplus. That outcome should force serious reconsideration of how tariffs actually function economically. Trade policy built on assumptions rather than aid tends to produce surprises. Canada adapted quickly, found new buyers, and turned pressure into genuine opportunity. Whether Washington adjusts course remains uncertain, but current numbers speak for themselves. This is exactly the kind of real-time economic story worth tracking. Markets move fast, policies react slowly, and producers adapt faster than either. That gap between policy intention and market reality defines this entire story. And the question that remains is not whether this rerouting will continue. The question is what happens when the next tariff is announced. Will producers adapt faster than policymakers can respond? Will supply chains become so flexible that economic pressure becomes meaningless? Or will Washington learn the lesson that Canada just taught them? That question will define the future of trade policy, not just aluminum, Because the real competition is not over tariffs. It is over who can adapt faster, who can find the next buyer, who can reroute supply before the policy takes effect, and who understands that in a global market, the flow of goods follows the flow of profit, not the flow of political announcements. That lesson is now embedded in every ton of aluminum crossing the Atlantic.